Welcome to the Hurst Trading Room. This is our video update for the 25th of February 2013, and in case you missed last week's video, you should know that our format has changed slightly, and I am tracking the four instruments that we have been speaking about in the Hurst Trading Room, but I am also broadening our horizons, and I'm taking a look at different markets each week. And in this week's video I will be taking a look at the precious metals, gold and silver. They are both instruments which I analyze upside down using inverted analysis, so they make for a really interesting study. As always, before we take a look at the markets, please make sure that you have read and understood the disclaimers. Let's start by taking a look at the S&P 500. In last week's video, I spoke about how I expect that we will, with the benefit of hindsight, see that the 80-day cycle trough did in fact occur as a hidden cycle trough at the beginning of February. And of course, you know that I believe that there is a 20-week dominant cycle, which means that the market will go up for the first half, roughly, of that 20-week cycle, and then it will go down for some time into the 18-month cycle trough, which we are still expecting sometime in about April, probably, for that 18-month cycle trough. And in last week's video, I also spoke about how following a hidden 80-day cycle trough, as we saw in this market, we would expect very often for there to be a straddled 40-day cycle trough. And so the market will bounce out of this 80-day cycle trough, come up, form a peak, come down into the 40-day cycle trough. And you can see the nest of lows there in early March, so we're expecting the 40-day cycle trough sometime here, and then the market will bounce back up again and form what's called a straddled trough. And one of the symptoms of a straddled trough is that you get symmetrical price action surrounding that trough. So it's very possible that price will come down into this 40-day cycle trough and then bounce up and form a second peak, which might be equal to this first one that we saw last week. It might even be slightly higher, or it might not get quite as high, but it is likely to be fairly symmetrical. You don't see a symmetrical or a straddled trough of the 40-day cycle every time there is a hidden 80-day cycle trough, but it is something that you do often see. And so, of course, last week we were standing by to enter into a short B category trade, and you know that we very rarely enter into a B category short trade, but the one time that we do is following a subtle or straddled or hidden 80-day cycle trough, which is, of course, exactly the situation that we are looking at the moment. And so last week, as price rose up to form another higher peak in the S&P 500, I set my entry levels at the level of the 20-day FLD, and of course we were stopped into that short trade. So we'll take a look at that in a moment. First of all, has anything happened in terms of what's happening now in the market to disqualify this analysis? No, not at all. It is possible, of course, that the market in the trough that it formed on Thursday of last week was actually forming the 80-day cycle trough. That is possible. So I've been speaking about the 80-day cycle trough as being a hidden trough in the first week of February, but it is just possible that that 80-day cycle trough only occurred last week on Thursday. One of the reasons why I don't think that that is true is because of this very prominent 40-day cycle trough over here. This trough in the last week of December 2012 looks to me a very likely 40-day cycle trough, which of course it is in this analysis. That's the 40-day cycle trough. And if we count the number of bars between that trough and last week Thursday's trough, you will see there were 55 bars between those two troughs. Now 55 bars or 55 days is too long for a 40-day cycle. And so I think it's unlikely that last week Thursday's trough was a trough of the 80-day cycle. I think it's more likely that last week, Thursday's trough, was a trough of the 20-day cycle, which is, of course, what is being presented in this analysis at the moment, as you can see, because there is the 20-day cycle trough for Thursday of last week. And I think that that is more likely to be the case in terms of what's happening in the market. So what has happened since the price fell through the 20-day FLD? Well, let's zoom in a little and take a closer look. And here it is. Let's turn on trading so we can see the trade that we actually made there. And here is the level of the FLD. As you can see, price came down through that FLD, and on the next day, on the Thursday, it hit our T1 target. There is T1 over there. Now, when we hit the T1 target, we also, of course, immediately adjust our stop loss. So we reduce our risk to 1/6 of the total risk that we are taking on this trading opportunity. Our T2 target, you can see, is just a little bit below the low of Thursday's price action. It's sitting at 14.94. So price almost came down to that T2 target, and you will know that when price almost reaches your T2 target, you often should take protective steps to exit from your remaining trades because that T2 target has almost been reached. Now, immediately having almost reached that T2 target, price bounced back up to the 20-day FLD. And on Friday, it was back up at the level of the 20-day FLD, as you can see. I'm recording this early on Monday, and the markets aren't even open yet in the United States, but you can see that price is still sitting squarely on that 20-day FLD. So it's a very good illustration yet again of how powerful the FLD line is. The FLD is a line that means a lot to the markets, and you very often see, of course, the price will rise back up to an FLD after crossing below it, particularly when there's quite a lot of emotion involved. And there's a lot of emotion involved at the moment in the US markets because they've just achieved new peaks. The US markets are very fractured. The Nasdaq, for instance, did not achieve a new peak. The S&P 500 and the Dow did. And there's quite a lot of emotion surrounding what's happening in the US markets at the moment. Markets generally around the world have been heading down. They've been more bearish than the US markets, and the US markets have been sort of buoyed upwards. And it's almost as though people don't really want to accept that that this bull run might be over. I certainly believe this bull run is over and that the market is going to be heading down. As I pointed out earlier, we have a 20-week dominant cycle, and that 20-week cycle should be carrying these markets down, certainly fairly soon. So it's not unusual to see the price bounce straight back to the 20-day FLD. I've got my stops on the two remaining trades here at this level here, 15.20.75, and so I'm happy with my stops there. If price does continue to bounce back up again, it might even form what might be a very early straddled trough over here. It might come right back up to the level of the previous peaks. If that happens, then of course I will exit from this trading opportunity with a small loss, only 1/6 of the original risk that I was taking on this trade. But I have no reason to get out of this market very urgently. I believe that the market is turning down, and that being in a short trade is the right place to be at the moment in the S&P 500. Let's take a look at the Nasdaq. Now, in the Nasdaq, as you know, I've been tracking the alternate analysis that I believe might be playing out in the US markets at the moment, which positions an 18-month cycle trough here in mid-November 2012, and then the prominent trough towards the end of 2012 in the last week of December is in fact a trough of the 80-day cycle. And you know that the reason why that is most likely to be true is that following an 18-month cycle trough, of course, we have a bullish underlying trend, and therefore we expect troughs of cycles to occur early. Recently, the Nasdaq, as you know, has been trapped in a bit of a range over here, and it's been difficult to trade because, of course, it has been tracking along this FLD for several weeks. 2 weeks ago, it broke up above the FLD, crossed below it. I entered into a short trade, but last week, particularly with the other markets not looking very bearish, I set a tight stop on that trade and in fact exited at the level of the FLD as price bounced back up again. But I was nevertheless standing by to get straight back into a short trade in the Nasdaq. And in a moment we'll zoom in and take a look at that. Just a few other things about this particular analysis. You will see that there have been 101 bars since the 18-month cycle trough in the middle of November. And there have been 56 bars since the 80-day cycle trough that, according to this analysis, occurred at the end of 2012. And so the trough that formed last week on Thursday in the S&P 500, I said, could that have been an 80-day cycle trough? According to this analysis, of course, this could have been a 20-week cycle trough. And the reason why that could have been a trough of the 20-week cycle is because 56 bars is not too short for an 80-day cycle. It is too long, as we saw in the S&P 500, for a 40-day cycle, but it's not too short for an 80-day cycle. So it is possible that the Nasdaq has formed let me see if I can draw the cycle shape here, has formed a sort of a slightly distorted M-shaped cycle, and in fact formed this 20-week cycle trough on Thursday of last week. That is possible. And so we need to bear that in mind, and we need to stand by to potentially enter into an A category trade next. Let's just zoom in here and see what happened to our trade last week. First of all, we were already in a short trade, and here was the level of the FLD. And as price bounced back up again and headed towards that FLD, particularly as the other markets were looking very buoyant, I set my tight stop here at the level of that FLD, which of course was also at a level of this trend line coming down over there. So it was quite a powerful line, quite a powerful level, and cut my losses basically as price bounced back up through there, but immediately stood by to enter into another short trade if price came back down below the FLD. Now, I couldn't set my entry level at the level of the FLD because, as you can see, the FLD was right within the previous day's trading range, and so I could have set it a little bit below the low of the day. I didn't, because on Monday there was an ever so slightly lower low, and on Friday there was an even slightly lower low over there. So in fact I set my entry at the level of Friday's low, which you'll know is the sensible thing to do when price is tracking along an FLD or straddling that FLD. You have to be careful about setting your entry level clear of the noise that happens in a market, and so my entry level was at the level of previous Friday's low, and so we were stopped into a short trade on Wednesday, and our T1 target was hit on the same day over here, at which point we of course reduced our risk on the trade and took a small profit. Our T2 target was hit over here the next day on the Thursday, and our risk on this trading opportunity was reduced to 0 because of course our stop loss on our trade 3 was brought down to the entry level, so that's now a break-even stop loss at the level of 27.52. And so the worst thing that can happen now is that we take our T1 profit and our T2 profit and break even on our trade 3. and so it has been a profitable trading opportunity. It's been a very, very brief and very quick trading opportunity. And so what's happening now? Well, we must bear in mind that the analysis that is informing this particular trading opportunity is suggesting that there is a 20-week nest of lows occurring round about now. And so it is very possible that this trough on last week, Thursday, is a trough of the 20-week cycle. Okay, it is possible. Now, how is it possible that we can have such a small and subtle 20-week cycle? Well, as you know, in the Nasdaq at the moment, we are looking at a 40-week dominant cycle, and with a 40-week dominant cycle, we do expect the 20-week cycle trough to be very subtle, which means it might either be straddled or it might be hidden, but it is certainly likely to be a very small trough considering the magnitude of 20 weeks. And so I wouldn't be surprised to see the Nasdaq form this 20-week cycle trough last week. It might bounce out, and it might form a fairly symmetrical price action around there, which means that we would be exited out of our short trade. I would enter into a long trade at the level of the FLD, because bouncing out of a 20-week cycle trough, even one which is straddled, we are likely to be able to take a little bit of profit out of the market. I'm feeling generally bearish the US markets at the moment because, of course, I do believe they are turning down, but with some caution, we could take some profit out of a bounce out of this trough, particularly if it does turn out to be a 20-week cycle trough, of course. And so that's the situation in the Nasdaq. We have an open trade 3 and are standing by to enter into a potential, probably very quick A category long trade. Let's take a look at the euro to US dollar. Now, you know that I have been tracking two different analyses in the euro to US dollar. Both of them have a 20-week cycle trough in the middle of November. The short cycle analysis, which is this one, has a very short 80-day cycle, which formed a trough in the first week of 2013. And according to this analysis, of course, we entered into a short trade as price broke down below the FLD at the beginning of February, as price came down to the 40-day cycle trough. Now, price then rose back towards the FLD, didn't in fact cross it, didn't even touch it. It rode just below it, and it continued doing exactly that last week. So as I mentioned last week, it seems as if though this analysis perhaps is not the correct one, because this interaction that we witnessed 2 weeks ago looks very much like a category G interaction. As I mentioned last week, it's not impossible that price can come up to the FLD, fiddle around, and then break up above it, and that could have been a genuine E category interaction. But it was certainly tilting the odds towards the alternate analysis, which indicates that there are longer cycles playing out in the market. So let's quickly take a look at that analysis. Here is that analysis, and as you can see, the 20-week cycle is still there in the middle of November. The difference is that this trough in the first week of 2013 is a trough of only the 40-day cycle, which makes that a long 40-day cycle, but not impossibly long. And you will notice that, of course, this analysis has been playing out with a good degree of symmetry. Particularly if we count the bars from the 20-week cycle, you can see there have been 104 bars up to and including today, and there have been 52 bars up to and including today since the most recent 40-day cycle. So there's a tremendous amount of symmetry. Okay, we have two perfect 52 bar periods of time there. All right, except of course we need to subtract three bars there because the trough potentially here occurred on the Friday. So we're looking at sort of 52 and 49, something like that. but there's certainly a good degree of symmetry, and the cycle shapes are looking quite good. And I went through the FLD price sequence last week, so I won't bother doing that again in too much detail. But of course, what we were looking at last week was possibly a G and then H category interaction as price breaks down below there. So last week I was standing by to potentially, according to the short cycle analysis, enter into a long trade, or enter into a short trade to catch the last bit of the H category interaction. Something interesting happened in the markets last week, and let's go back to the other analysis and zoom in a bit so that I can show you what did happen. Here we go. Let's just turn off the trading information for now, and you can see that last week, of course, I was watching the level of this FLD very carefully. There's the level of the FLD, and price had been sort of tracking along it, although a little bit below it. And as it rose up into this peak in the FLD, it started exhibiting the behavior that one very often sees in a G and H category interaction, where price tracks along the FLD, often absolutely perfectly. I think you can see that, how price was really just moving along that FLD, and so of course that was the G category interaction. G is when price moves towards the FLD. H is when price breaks away from it, and so we were offered a great opportunity for getting into an H category short trade, because here was our low, and if price went up above the FLD, then I would have entered into a long E category trading opportunity. And if price broke down below this low from the previous week, then that would have been our H category trading opportunity. And that is indeed what I did, because price on the Wednesday fell down very hard and broke down through that low. And let's zoom in even slightly further, and here you can see that as price broke down below this low of the previous Friday, we entered into a short trade, probably an H category short trading opportunity. Our T1 target was hit on the next day, on Thursday, and our T1 target was about over there. Our T2 target was hit late in the day on Friday, over there. That was our T2 target, and therefore our remaining stop loss on our trade 3 is brought to the entry level, and so we've taken some profit out of this trade. Often H category trading opportunities you need to be quite quick getting into and getting out of, and so this trading opportunity might be over. And it is possible that the trough on Friday turns out to be the trough that the market has been moving down to. Of course, the big question is that a trough of the 80-day cycle or a trough of the 40-day cycle? And so let's just do a little bit of measuring here. We'll turn off that trading information and let's just measure some cycle lengths here and see if we can come up with any definite evidence of whether that trough has formed or which of these two analyses is indeed correct. First of all, is it possible that this trough that potentially formed on Friday was a trough of the 40-day cycle, which is what this analysis is showing us, because there is, of course, the nest of lows for the 40-day cycle? Well, yes, it is possible. As I've already mentioned, there are 52 bars since that trough at the beginning of 2013, and that trough formed potentially on Friday. That's 3 bars ago, and so that would have been a 49 bar cycle or 49-day cycle, and so it is possible that that is a 40-day cycle. So this is still possible, this analysis. However, particularly with the recent price action, I think that this analysis is probably not the correct analysis, and that the correct analysis now is the long cycle analysis, which of course indicates that the market is heading down into an 80-day cycle trough. There is the nest of lows, and as you can see, there have been 104 bars since the 20-week cycle in middle of November. And if the trough did form on Friday, which is possible, then that would have been a cycle length of 101 bars or 101 days, and that is pretty much as long as you can get for an 80-day cycle. It is just possible to have an 80-day cycle of 102, perhaps 103 bars, but certainly not much longer than that. So it is possible that this analysis that we're looking at here, the long cycle analysis, which we've been keeping an eye on for several weeks now, it's possible that this is the analysis that's going to turn out to be the correct analysis. And so it is probable that this market is now bouncing out of this trough, either a 40-day cycle trough or an 80-day cycle trough. Whichever trough it is bouncing out of, I would be interested in getting into a long trade as price crosses this FLD. And so I will certainly be entering into a long trade at the level of the FLD. What is the big danger here? The big danger here is that we get a double GH interaction, and we've seen several double GH interactions recently in the markets. Here is the GH interaction on the chart, and as you know, we do often get double GH interactions. But we most usually get double GH interactions when there is bearish underlying trend, and we don't have a bearish underlying trend in this case, so I'm not expecting a double GH interaction. And the other reason why I don't expect a double GH interaction is because I believe that the trough that most probably formed last week is a trough of the 80-day cycle, and that cycle is already 101 bars long, and I don't expect that cycle to get much longer than that. Okay, so therefore I believe that a long trade in the euro to US dollar is appropriate as our next trading opportunity. Let's take a look at the British pound to US dollar. The British pound to US dollar was for some time my favorite instrument. We made several very profitable trades in a row on the British pound to US dollar, and then made a losing trade over here, because here we did see a double GH interaction. GH, GH. Okay, that was our double GH interaction. As I've just mentioned, not unusual when you have a bearish underlying trend, which we do have here, because the market is heading down towards this big 18-month cycle nest of lows. Now, we made a small profitable trade 2 weeks ago, or 3 weeks ago now, which was, at the time, I believed an A category trade as price bounced out of the 80-day cycle trough, which at the time I thought might have occurred over here. And I'm going to put it there because I do still think it is still possible that the 80-day cycle trough did in fact form at that point. How is that possible? Because surely following an 80-day cycle trough, price should bounce a lot. Well, not necessarily. Remember, it's always very important to determine what your dominant cycle is. And in the British pound to US dollar for some time now, we have known that there is a 40-week dominant cycle. And that's very important information. And one of the things that you should know, of course, is that if the dominant cycle is a 40-week cycle, then we will see a big shape here, which will look nice and clear and will be of 40-week length, and that the 80-day cycle troughs on the way up will be small, subtle, hidden perhaps. Here is that 80-day cycle trough. It was indeed a very subtle trough. Price went down for only 5 days and then bounced straight back up again. Very subtle trough there. So there's our first subtle trough. And the other time that we will of course have a subtle trough is on the way down. The 80-day cycle trough might also turn out to be a subtle trough on the way down. And so I believe that that is probably what we have seen playing out in the British pound to US dollar. It is not impossible that the 80-day cycle trough is just occurring now. Perhaps it even occurred today. As you can see, the market fell to a new low this morning and has been bouncing up strongly ever since. So it is not impossible that the 80-day cycle trough in fact occurred today. But it wouldn't surprise me if, with the benefit of retrospect, we look back and we see that in fact that 80-day cycle trough occurred as a subtle trough back at the beginning of February. So the important thing, of course, is to decide what we should do in terms of our trading. So let's quickly have a look at that. First of all, if the 80-day cycle trough has not occurred yet, or perhaps occurred today, then what would be our next trade? Our next trade would be an A category long trade, of course, as price bounces out of that 80-day cycle trough. And let's quickly look at how many bars there have been. Now, in the euro to US dollar, we were looking at 101 bars. Here you can see there have been 102 bars since this 20-week cycle trough in the middle of November. There's our 20-week cycle trough. 102 bars. I mentioned when speaking about the euro to US dollar that 101 is a very long cycle for an 80-day cycle. 102 bars is also very long, of course, possibly too long. And that is one of the reasons why I believe that in fact the 80-day cycle trough might have occurred either here or over here. The most likely one probably is over here. So I wouldn't be surprised if that was an 80-day cycle hidden trough. In other words, very, very difficult to see or to identify. And so if that 80-day cycle trough did occur back then what's happening in terms of our trading? Well, our FLD and price interaction sequence would have been A, as price broke up above the FLD, and that was in fact a profitable trading opportunity that we did take. It was a very small a profit that we made from that because we in fact exited only a few days after entering it, as it became clear that the bearish pressures of the market were forcing the trade, or forcing the British pound down again. And so of course here, as price broke down below the FLD, that's our B category opportunity. Where is our C category opportunity? Our C category opportunity would occur as price bounces out of the 20-day cycle trough following this 80-day cycle trough. And where is that? Well, that is probably or possibly the trough that price is bouncing out of now. So it is possible that this trough that has formed today, and of course tomorrow price might come down below it, in which case there won't be a trough, but if price continues to move upwards, it is possible that this is the 20-day cycle trough following a hidden or very subtle 80-day cycle trough. Now, would I want to enter into a C category long trade as price bounces out of that 20-day cycle trough? No, I wouldn't. Because the market is being so distorted by the dominant cycle. Never forget your dominant cycle. The dominant cycle is distorting the market, and the dominant cycle is the 40-week cycle, and it is pressing down very strongly at the moment. So I would not want to enter into a long C category trade in the British pound to US dollar. The FLD at the moment is very far above the market, so it's very unlikely that we would be stopped into a trade this week. But of course, we need to consider all possible options. And so, if price does come back up to that FLD, then it could mean basically one of two things. Either that is the A category trade as price bounces out of an 80-day cycle trough. I think that is not very likely. I think that what is more likely is that price will come up to the FLD and maybe cross over it just slightly and then come down again, heading down towards the 40-day cycle trough, which we would be expecting sometime in March, assuming that the 80-day cycle trough has been over here and has been hidden. So there are no very clear and simple trading decisions to be made in the British pound to US dollar, in my opinion, at the moment. I think that the 40-week cycle is definitely very dominant, and I'm not going to jump into a long trade. So yes, it could be an A category trading opportunity, but in that case I'm going to pass it up, because I also think that it's possible that we saw an 80-day cycle hidden trough at the beginning of February, and the dominant cycle is distorting our sequence so much to the downside that it becomes difficult to trade with that sequence. If price comes up just slightly above the FLD over the next week or two, then in fact we might get a good D category short trading opportunity, but that opportunity is a few weeks away. So at the moment I am going to be standing aside. I'm not going to be entering into a trade in the British pound to US dollar. Let's take a look at some other trading opportunities, and I thought that today I would take a look at gold and silver, two precious metals. Let's take a look at gold first. The first thing to understand about gold is that I believe that the analysis should be inverted. In other words, the peaks are synchronized as opposed to the troughs. And there's lots of information in the FLD trading strategy, particularly in the final module 6, about inverted analyses and why we do it, so I won't dwell on that here. Let's take a look at the longer term picture and see what's been happening to gold. This is a really long-term picture. Let me change that to a weekly chart, and here you can see the really long-term picture in terms of gold. Gold pretty much sort of headed straight up, as you can see, for a really long time. This data only goes back to 2004, and gold formed a peak in 2011. It was in September of 2011. And the big question at that time, if you've been reading the blog that I post every weekend, you'll know that we've been discussing this since September 2011, in fact, is whether that peak was a peak of the 18-month cycle. Well, it certainly was a peak of the 18-month cycle, but the big question is, was it also a peak of the 54-month cycle? Potentially even a longer cycle, a 9-year cycle perhaps. So that is the very big question, and we can't say with absolute certainty yet whether that was a peak of the 54-month cycle or whether in fact it was only a peak of the 18-month cycle. Now, what's the big difference? Well, if that was a peak of only 18-month magnitude, then that means that we have another 18-month cycle to go to get to the 54-month cycle peak. And for some time it looked as if though that was what might be unfolding. However, as you know from the blog that I post over the weekends, recent action in gold has been fairly bearish and would seem to indicate that those longer cycles have turned down, which means that very likely the peak in September of 2011 was a peak of the 54-month cycle. Okay, so that's a little bit of background to this analysis. Let's zoom in. You can see that this analysis does in fact position the peak of the 54-month cycle in September of 2011. And so there's the peak of the 54-month cycle. And so of course the trading decisions that I'm making in gold at the moment are based on the fact that the 54-month cycle peaked in September of 2011. What has played out since then? Well, you will know that if you read the blog that I post over the weekends, you will know that I think that this peak, which formed in, I think it was early October of last year, was in fact a peak of the 40-week cycle. And you will see that in this analysis, there is a yellow triangle there, which means that this was a peak, according to this analysis, of the 18-month cycle. Now, we could debate this, and you could follow two separate analyses in your workspace, which is probably a good idea. But I believe that particularly with recent price action, I believe that the odds have swung towards that having been a short 18-month cycle instead of a very long 40-week cycle. Now, I might change my mind about this. Very often cycles do run long in gold, but you must bear in mind that if this peak in September of 2011 was a peak of 54-month cycle magnitude, then we would in fact expect the peak of the next 18-month cycle to occur early, because of course we're dealing with an inverted analysis here. And so that is the analysis that I'm focusing on in terms of identifying trading opportunities. Let's zoom in and see what's been happening since that peak of the 18-month cycle in early October of 2012. And here you can see that according to this analysis, we have an 80-day cycle peak over here in the middle of November. So that's an 80-day cycle peak. And we have a 20-week cycle peak over here. Now, Sentient Trader has positioned that peak, as you can see, at the beginning of February, as opposed to at the more prominent position of this peak over here in the middle of January. And there are various reasons why it has done that. And in a moment, when we take a look at silver, I'm going to show you how I trade these two closely correlated instruments by tracking one analysis in the one and the slightly different analysis in the other one. The more obvious position for the 20-week cycle trough is, of course, at this more prominent peak over here in the middle of January. But it's not impossible that the 20-week cycle peak did in fact occur over here in the first week of February. One of the reasons why it is possible, if not probable, that the 20-week cycle peak did form the beginning of February is because that date, the beginning of February, is the date that we're seeing in many of our other instruments. All right, that first week of February proved to be a turning point for many other instruments. And so very often, of course, you find this commonality between markets, even when those markets are inverted instruments. And so it's certainly very possible that that 20-week cycle peak did occur in February. And something else developed here in gold, that is that we had the development of a little bit of a triangle. Okay, I'm not going to be too sort of specific about the drawing of that triangle, but there was definitely the development of a bit of a triangle over the last few months. And of course, the most important part of the triangle, if you like, is the final bit of the triangle, and that was what happened in February. So the positioning of that 20-week cycle peak in February, I think, is possibly a really good position for that peak. So I'm leaving it. Sentient Trader, this is Sentient Trader's default analysis, so I'm leaving it as it is because I think that very probably was a peak of the 20-week cycle. And that, of course, was followed by a very strong move down. And so let's take a look at what we're expecting to happen in gold now following that strong move down. And let me just zoom in over here and take a look at the FLD and price interactions. And let's count some bars here. Let's count the bars since the 20-week cycle peak. As you can see, there have been 20 bars, which means the price is now most probably rising up towards the 20-day cycle peak. And let's just take a look at the interactions here. There has been only one since the peak of the 20-week cycle, and that was, of course, our A category short trading opportunity, which proved to be a very profitable trading opportunity. Price is now bouncing back up towards the 20-day FLD. And so am I considering buying into gold? I'm actually not. And the reason for that is because I think there's a good chance that this will turn into a B category interaction, which is an interaction that I don't want to buy into. I would rather wait until price come up to the FLD, probably get repelled downwards again, and then trade long for the D category interaction. Now, what if this 20-week cycle peak should not be placed at the beginning of February, but should be placed in the middle of January? Well, if that's the case, then here would be our category FLD and price interactions. Here would have been, in fact, let me clear this so that it's a little easier to read. If the 20-week cycle peak was over here, then of course this would have been our A category interaction over there. Here was B, and here was C, and this very big move was a short C category trading opportunity. And so the next trading opportunity would be a D category long trading opportunity, which of course we would want to take. So we have a little bit of an analysis dilemma here in terms of what we should be doing next with gold. The way in which I resolve that is I'm not going to enter into a long trade as price comes up to the FLD because I'm going to step back and I'm going to wait and watch it. The worst thing that could happen is that I miss a good trading opportunity. I will be taking that trading opportunity in silver, which is why I'm speaking about both of these instruments in this video, because they are of course closely correlated. So I will take that opportunity in silver. I won't take that opportunity in gold, and the worst that'll happen is that I miss an opportunity. Now, why do I continue to favor the position of the 20-week cycle peak over here when, as we've just seen, we had a good sequence of interactions? The reason that I continue to favor it is because of the position of this 40-day cycle peak. If I move this, and I can pin this trough, this 20-week cycle trough, peak, I beg your pardon, if I pin this 20-week cycle peak to the middle of January, then this peak over here cannot be a peak of the 40-day cycle. And we'll see this in a moment in silver. And so for me, that is not quite such a satisfactory solution to this analysis. Let's take a look at the FLD and price interactions over the previous 80-day cycle period. Here was our A category short interaction. Here was B surrounding the 20-day cycle peak. Here was C as price broke back down again. Here was D as price climbed back up to the 40-day cycle peak, and E as it broke down below the FLD again, and F as it came up again. And then here we have a little bit of a question mark. Was this a G, H, or was this the G, H over here? All right. So there are sort of various ways of looking at that and analyzing it. The way that I choose is the way that's presented on this chart at the moment, which is that we had a G interaction over here and an H interaction following that towards the end of January, leading to the 20-week cycle peak in the first week of February. And as I've pointed out, the reason why I favor that opportunity is because of the development of this little bit of triangular price action over there. And the 20-week cycle peak most probably occurred on the final touch of price against that triangle boundary. So that's what I believe is happening in gold at the moment. And let's take a quick look at silver. The two instruments are, of course, very closely correlated. First of all, the bigger picture in silver positions a 54-month cycle peak in 2011. It was not in September of 2011. It was, in fact, of April of 2011. So that's an interesting difference between silver and gold. And you'll often find that between two closely correlated instruments, that they beat with a slightly different rhythm. And that's an interesting thing that happens between silver and gold, that their rhythm is slightly different, but there is also often a great degree in common between the two, of course. Interestingly, we see here what looks to be a 3-year dominant cycle. And you'll know that I've been speaking a fair bit about 3-year dominant cycles, because we see a 6-year dominant cycle potentially in the US markets, and last week I spoke about a 3-year dominant cycle in the Japanese yen. So we're seeing the same 3-year dominant cycle in silver and to some extent in gold. It's an interesting thing because, of course, 3 years is not a cycle that belongs to Hurst's nominal model. I spoke about that last week, and so I won't dwell on it here. Let's zoom in and take a look at what's been happening. Well, as you can see, our first 18-month cycle since the 54-month cycle peak in April of 2011 has elapsed, and it formed a peak in October of 2012. Another reason why I believe that peak in October 2012 might have been a peak of the 18-month cycle in gold as opposed to the 40-week cycle, because we're seeing the same cycle peak in silver. So here is that 18-month cycle peak in October of 2012. Let's zoom in and see what's happened since then. Here in silver we can see some very nice W-shaped, of course they're W-shaped because they're upside down, it's an inverted analysis, W-shaped cycles playing out in silver. And here was the first 80-day cycle peak following the 18-month cycle peak of October 2012. There's the 80-day cycle peak, and here is the 20-week cycle peak in the middle or third week of January 2013. So that is probably the peak of the 20-week cycle. Now you know that in gold, that 20-week cycle peak was positioned over here in the first week of February, and I mentioned that I'm dealing with that analysis uncertainty by tracking the alternate analysis, this analysis, in silver. So I believe that the 20-week cycle in silver, the 20-week cycle peak, occurred towards the end of January as indicated on this chart. So let's take a look at what's been happening since then. Of course, the price of silver has come down fairly hard. Let's see if we can identify our FLD and price interactions. Here is our A category interaction as price crossed down below there. Looks like a perfect A category interaction with price pretty much exactly reaching the target, something that you often see with an A category interaction. Price came back up to the FLD, that's our typical B category interaction, and then it tracked along for a few days. It was clear of the FLD for 2 days over there, but then it broke back down below the FLD. That's our C category interaction in time with the 20-day cycle peak. So everything's looking like a very true FLD and price picture, and that C category short interaction of course provided us with a very profitable trading opportunity as price came down there, and now we're expecting price to rise back up to the 40-day cycle peak. There you can see the nest of highs, all right, because this is an inverted analysis. So that 40-day cycle peak is expected to occur round about now, and here is the FLD, and so our trading opportunity, our next trading opportunity in silver is a D category long trade. So we have an interesting picture in the precious metals. Things are certainly in longer term sort of a picture looking fairly bearish, and I think it is going to be several years before we see price reaching the levels of late 2011. So we have a long-term bearish picture. Our next trading opportunity is a long trade, a D category trade, and it's a trade that I will be taking in silver, but I won't be taking it in gold because there are two possible things playing out in these analyses. It works better in silver, I believe, and so a D category long trade in silver looks as if though it will be appropriate and will prove to be profitable, and in gold I'll be standing back and waiting instead to take the next bearish trading opportunity in gold. That's it for our video update for the 25th of February 2013. As always, if you have any comments or questions, please put them into the comment box below this video. I look forward to seeing you next week in the Hurst trading room, and as always, profitable trading.